Most investors think a high dividend yield is an automatic win for their portfolio. That belief is actually one of the most dangerous mistakes you can make today. A massive yield can easily be a warning sign of a dying company. When a stock price collapses, its dividend yield mathematically spikes into the stratosphere. If you buy blindly, you are catching a falling knife instead of building wealth. Today, we are breaking down how to spot the real winners in 2026. To trade effectively, you must understand exactly how yield works in the market. Yield is not a random bonus percentage that a company hands out to shareholders. It is a shifting ratio between a company's payout and its current stock price. Imagine a retail stock trading at $100 per share in the market. If that business pays $4 in annual dividends, your yield is 4%. But what happens if the stock price drops to $50 tomorrow morning? Suddenly, that exact same $4 payout looks like an 8% yield. The business did not grow more profitable, it just lost half its value. What most people don't know is that high yields often hide broken business models. Before you skip to the end, look at how smart money uses this metric. Professional traders do not just stare at the highest percentage on a screener. They calculate the dividend payout ratio to see if the income is safe. This ratio compares the total dividends paid to the total net income. If a company pays out 90% of its earnings, trouble is coming. They will have no cash left to grow or cover unexpected economic downturns. A healthy dividend yield is completely derived from consistent, predictable free cash flow. Companies with wide economic moats can easily maintain these payments through any recession. Think about utility providers, major healthcare giants, and essential consumer staple brands. People always need electricity, life-saving medication, and daily household items to survive. These steady businesses generate massive piles of cash every single quarter of the year. They choose to return that excess cash to you, the loyal equity investor. The surprising part comes next when we look at the actual math of compounding. Reinvesting your dividend yield creates a powerful snowball effect for your personal wealth. Your dividends buy more shares, which then generate even more dividends next quarter. Over a decade, this process completely transforms the total return of your portfolio. Now that you know the mechanics, let us look at the market leaders. Our first major pick for this year is the pharmaceutical titan Pfizer. Right now, Pfizer is offering investors an incredibly attractive yield of 6.3%. The stock has traded at a discount due to recent patent expirations. However, their massive cash reserves easily protect this high-paying quarterly dividend distribution. Investors looking for steady cash flow are watching this healthcare giant very closely. Next up on our radar is the consumer staples powerhouse Altria Group. Altria consistently sits near the top of income lists with an 8.5% yield. They possess massive pricing power that keeps their revenue steady year after year. Even as traditional product volumes decline, their cash generation remains remarkably resilient. If you are enjoying this breakdown, hit the subscribe button right now. We post fresh financial market deep dives every single day to sharpen your trading. Turning to telecom, AT&T is our third essential yield stock to watch. AT&T is currently supporting a strong dividend yield of 6.5%. They have spent years reducing debt and focusing heavily on core 5G infrastructure. This disciplined approach ensures their massive wireless subscription revenue covers the payout easily. The telecom sector remains a classic haven for investors seeking high, defensive yields. Right beside them, in the telecom space, is their main competitor, Verizon Communications. Verizon is trading at a level that creates a stellar 6.4% yield. Their premium network allows them to maintain incredibly steady consumer cash flows. While growth is slow, the dividend safety profile remains highly attractive for intermediate traders. For our fifth asset, we look across the Atlantic to the energy giant Enel. This Italian utility provider is currently yielding an impressive 6.8%. They are a dominant force in the global renewable energy transition. What most people don't know is how stable regulated utility assets truly are. Their revenue is practically guaranteed by government contracts, which secures your cash flow. Before we move to the final 5, remember that diversification is your shield. Never put your entire trading account into just one single high-yielding sector. Moving right along, our 6th pick takes us into the real estate sector. Realty Income is a famous retail real estate investment trust yielding 5.8%. They own thousands of properties leased to investment-grade tenants like grocery stores. These tenants pay rent every month, which funds a rare monthly dividend payout. For consistent, predictable income, this asset is incredibly difficult to beat in 2026. Our 7th selection is the massive midstream energy operator, Enterprise Products Partners. They currently boast a beautiful dividend distribution yield of 7.2%. They do not pump oil, they simply transport it through vast pipelines. Think of them as a toll booth for global energy infrastructure assets. Their cash flow depends on volume, not volatile commodity prices, making them safer. Stock number 8 shifts our focus to the British tobacco giant, British American Tobacco. This international consumer firm is currently yielding a massive 9.0%. Like Altria, they possess incredible brand loyalty and immense pricing power globally. They are rapidly expanding their modern smoke-free alternatives to secure future earnings growth. For our 9th position, we look at the financial giant Toronto Dominion Bank. TD Bank is offering a reliable and growing yield of 4.8%. Canadian banks operate in a highly regulated, low-competition domestic banking market. This protective environment has allowed them to pay uninterrupted dividends for generations. Finally, our 10th pick is the foundational global energy supermajor, Chevron Corporation. Chevron provides investors with a very healthy dividend yield of 4.2%. They possess one of the strongest balance sheets in the entire oil industry. Even if oil prices drop, their low production costs keep the dividend safe. The surprising part comes next when you look at how to execute these trades. Finding the stocks is easy, but timing your entry requires a clear strategy. You should always check the ex-dividend date before buying any yield asset. You must own the stock before this specific date to receive the payout. If you buy even one day late, you miss the upcoming cash distribution. Many amateur traders buy the day before and sell the day after. This strategy fails because stock prices drop by the exact dividend amount on the ex-dividend date. Instead, look to accumulate these high-quality shares during broader market pullbacks. Look out for what happened today on our next video, where we expose a massive shift in tech sector dividends. Stay disciplined, keep managing your portfolio risk, and we will see you over on our next video.